ultimately, one of the things that you need to know about the market is the way that you grow. The way that you are going to grow your account is not as much about having the perfect setup and all of that, though that is important. One of the ways that you're going to grow your account is through risk management. Because here's the thing most people don't want to tell you that are trying to sell courses or trying to sell a strategy to you or whatever. That's this, that every strategy that you can possibly learn about trading will fail at some point. There is no setup that is 100% fail-proof or foolproof. There is no market that is 100% guaranteed to work out the way that you think or hope it will, or even the way that the charts say that it's going to work out. So why are we talking about this before we look at charts? Because we're going to be teaching you a lot of strategies. And if you will combine the strategies of trading with these risk management strategies that we're talking about, this will help a lot. And the question we need to answer is, what about when the strategies stop working? What about when I get into a trade and I start to have losses one after another? How am I supposed to handle that? Because the reality is, any strategy that you use is going to work for a while, and then it's going to stop working. There are going to be times and markets where your strategy is hot and it's working all the time. And then there are going to be markets where your strategy doesn't work near as often as it once played out. Let me give you, and the beautiful thing about this is that these strategies that you're going to learn, many of them are strategies that have been used by traders for a really, really long time. And so when something stops working, it doesn't mean that it's going to stop working forever. It means that that current market climate or that current market environment, that strategy is not working. And so what you need to be able to do is survive so that when the market works out, you haven't given back all of your gains. You haven't lost a bunch of money in drawdowns, so that when your strategy starts playing out again, you can maximize that and make the most amount of money. Because here's what's going to happen. When your trade stops working, if you choose to have a one-size-fits-all approach to things like your position sizing, then when things stop working, what's going to end up happening is you're going to blow up your account. You're either going to have a humongous drawdown in your account where you give back all of the gains that you've made recently or more, or you will be break even because you didn't adapt. Or if you have a drawdown, because you will have a drawdown, everybody has drawdowns, it could be something as simple as just a small setback on an overall upward trending account, which is what I want for you. And some of the principles that I'm going to teach in this are how I keep my account trending upwards with higher highs and lower lows, all right? Because the best traders have drawdowns. The question is not if you're going to have a drawdown, it's when you're going to have a drawdown and how much of a drawdown you're going to have, how big of a drawdown you're going to have. And that is actually in your control. You've heard me say before in these videos that you can't control what the market does, but you can control what you can control. And one of the things that you can control is risk, which is why you have to understand some of these basic things about risk management, because the ability to control risk is absolutely in your hands. And it's one of the most important tools in a trader's toolbox. And when I talk about risk, the three areas that we're going to cover in this video are this. We're going to talk about controlling risk by making sure that we have a good profit factor. I'm going to talk about what that is and what that means. We're going to talk about stop losses. And then we're going to talk about position sizing and how you can control risk and all of those things. So the first thing I want to do is let's talk about what it means to have an appropriate profit factor in your trading. What does it mean to have an appropriate profit factor? Well, what you want to do, if you want to know what your profit factor is, you're going to do a very simple math equation that most fourth graders can do. All right. You can do this with a calculator if you're like me and you can't do this stuff in your head or on paper very well. But you're going to take any given period of time. I typically say if you're testing a new strategy, you want to give it about 20 to 50 trades. So whatever that time would be, you can look back, like if you're day trading, maybe 20 to 50 days of trading. And then you're going to take your gains and divide those by your losses, and that will give you your profit factor number, okay? A profit factor is a trader's bread and butter to figure out if their strategy is working and to figure out if they're doing a good job with risk management. Okay. So the number you want to shoot for is the higher number, the better in your profit factor. At a minimum, you want to have a profit factor of at least 1.5 or higher. 1.5 or higher is a healthy profit factor for a trader. So as you're trading, not only do you want to be able to look back at your trades and see, is my setup playing out? You can also use this to test strategies as well. You can look back and say, if I had gotten in here and I had gotten out here, what would that have looked like? Oh, I would have lost on this one. How much would I have lost? And if you can do that with about 20 to 50 trades, you can give yourself a profit factor for that setup. And you want to make sure that any setup you have has a 1.5 or higher profit factor. And in your trading in general, you want to make sure that you're following some of these rules to ensure that your profit factor is 1.5% on average. How do I do that? How do I control my profit factor? Well, there's two ways that you're going to do that. The first way that you're going to do that is you are going to use a setup that is proven. So you want to back test and see, hey, would this setup give me a profit factor of about 1.5 historically at minimum? Okay, so you can do a setup that's proven, and I'm going to teach you some of those setups in our upcoming videos. The second thing that you want to do is you want to make sure that you have a healthy risk to reward ratio. Now, when I talk about a healthy risk to reward ratio, here's what I mean. I mean, you want to make sure that the amount of money that you can make on a trade to the upside is higher than your potential losses to the downside. And we'll talk you through how to keep an appropriate risk reward ratio in some of these trades. But in whatever trade you take, you want to have a proper risk to reward ratio. And what you typically want to do is you don't want to go below a 1-to-2 risk reward ratio. What I mean by a proper risk reward ratio of 1-to-2 is that for every $1 you risk, you want to be able to make $2. So every $1 you could potentially swing to the downside, you want to make sure that you're at least potential reward is $2. Okay. So if you're trying to make $200 on a trade, you don't want to potentially lose more than $100 on every single trade. And here's the beautiful thing about that. You can look at this chart on your screen and you can see kind of an idea of what a proper risk reward looks like. And if you're keeping a 1-to-2 risk reward ratio, you only need to be right about 33% of the time to be profitable. So if you are right 40% of the time or higher on your trades, which any good trading setup is going to have, you are going to be a profitable trader if you're keeping a 1-to-2 risk reward ratio. If you veer into the 1-to-1 risk reward ratio, like gambling, where you are taking a chance at like a 50-50 shot at being right on this, and you're going all or nothing with your wins and losses, basically you have to be right more than 50% of the time to have a profit as a trader, because you will wipe away your profits. Even better, if you can get a 1-to-3 or a 1-to-4 risk reward ratio, then 1-to-3, you only have to be right 30% of the time to be profitable. 1-to-4, you only have to be right about 25% of the time to be profitable. And so it's important that you're keeping a good risk to reward ratio, and that's going to be reflective in your profit factor. If you're choosing a setup that plays out at least 40% of the time or higher, and you are keeping a 1-to-2 risk reward ratio, then your profit factor should easily fall into that 1.5 place. Second thing that I want to talk about is I want to talk about stop losses. Risk management involves stop losses. Stop losses are important because when you set a stop loss in your orders, you're saying, I cannot lose more than this amount of money. And a lot of people are afraid to do that. They don't want to put stop losses in. They've been told about market makers and stuff like that. But here's what I know. I know that putting an actual hard stop loss in place limits the potential downside on a trade and allows you to keep that risk reward exactly where you want it to be. I personally do not believe in mental stops. And one of the things I've found is I have studied many traders throughout history, some of the greatest traders alive today. I have yet to find The greatest traders alive today. I'm not talking about the people that you see on social media. I'm talking about the people that have actually traded in the pits. I'm talking about the people that have proven themselves consistently profitable for 20, 30, 40 years. They all have one thing in common. They all use stop losses. They all do, because they want to make sure that they are limiting their downside. And the reason it's important to limit your downside is because when you limit your downside, you're limiting your emotions. If you're relying on something like a mental stop loss to keep you, to tell you to get out of a trade, and you just have an idea in your head, if it drops below $20, I'm going to sell. Well, here's what happens. You'll start rationalizing with yourself when it hits, $19.99. Well, maybe it'll go back up and I can make this profitable. Next thing you know, it's at $19.50 and you're saying, well, if this gets up to 20, then I'll just break even on this trade. I'll get back up to what my stop loss was, and then we'll be good. And then what ends up happening is, next thing you know, you've taken what would have been a very controlled small loss, and because you kept it in here instead of actually setting a stop loss with your broker, you've caved to emotional trading and you've lost more money than you anticipated on trading. And I don't know a real life good trader who doesn't use stop losses. So stop losses are your friends. So what do stop losses look like for me? Well, I always have a stop loss on every single trade at the proper risk to reward ratio, which I've already talked about what that is. Another thing to consider is I consider a monthly stop loss on my account. So if I'm consistently losing, once I hit about 6 to 8% of loss on my account in a month, I'm going to call it quits for the month. I'm going to basically call for a redo, right? I'm going to just be like, I'm done. And then I'm just going to paper trade to keep my edge sharp. But 6 to 8% is the maximum that I'm willing to lose in my trading account in a given month. Now, 6 to 8%, if you're following some of the position sizing rules that I'm going to share in this video, it's going to take a while before you hit that 6 to 8%. There's going to be a lot of losses before you hit that percent, but that's the most I'm comfortable losing. And the reason that is because I know that I can actually make up that 6 to 8% with 1 month of good trading. That doesn't put me so far behind that I need a long time to catch up. Another thing to consider stop losses on are on your long-term investments. I will talk about some long-term investment swings, trading strategies and stuff like that. And what I do is I once I'm fully positioned in, so I'm not as worried about the price action up or down while I'm averaging into a long-term position. But once I get a full position and I'm fully positioned into a trade, then I set a trailing stop loss of 10%. I don't want to lose more than 10% on that trade, no matter what the upside is. And I also do this with my full account. So I keep a trailing stop. And this does have to be more in my head because your broker won't allow you to just sell all your positions if your account goes down. But basically, if I start hitting 10% trailing stop after another starts hitting, then I start to think about recessions, drawdowns in the market and stuff like that. And I get out. Kind of a full stop loss where I don't want to lose more than 10% in my account. I would rather get out there, wait for the market to reset, and get back in. Why 10% though? Why does 10% matter to me? Well, if you look at this chart that I am throwing up on the screen now, you can see that your losses are actually exponential compared to your gains, okay? So what I mean by that is, if you look at less than 10% of a loss, it's about a one-to-one rate to be able to catch up to that. And so, for example, is if you lose, say 8% on a trade, then you only need to get about 8.1% or so to get back up to break even. But once you get below 10% of a loss, your losses start to exponentially increase. And so when you hit 10% of a loss on a trade, well, now you need to make 11% just to be break even again. And those numbers can continue to get larger beyond 10%. So you can see on this chart that by the time you're down 30%, now you have to have a 43% gain to get back to break even on that trade. And so because of that, the reason I choose 10% is because 10% is the point where 10% is a big drawdown in the S&P 500. But the other reason I choose 10% is because that's when you start to lose the one-to-one trade-off on gains. Okay, so 10% is a hard stop loss for me in a variety of areas. So if you want good if you want good risk management, what you need is you need a healthy profit factor, you need stop losses, and finally, you need proper position sizing. Proper position sizing. Here's the thing, a one-size-fits-all approach to position sizing means that you are not listening to the market. The market is always speaking. And since you can't predict the market, and since you can't make the market do what you want it to do, you always need to be listening to the market. And a one-size-fits-all approach says, I'm not listening to the market. If I'm constantly throwing $10,000, $100,000 into every single trade, no matter how many times I win or how many times I lose, that's a recipe for disaster because I'm not listening to what the market is doing. And what will happen is when you start to have a series of losses because your strategy is not working in the current market environment, you will die death by 1,000 cuts. And your account will have a very large drawdown. And this is actually one of the big determining factors in whether someone is a break-even trader, a losing trader, or a profitable trader. It's their ability to adjust their position size as a form of risk management. So what does that look like for me? Well, just to make the math easier, I'm going to use the number 100. But let's say that my normal full position size in something is 100 shares, okay? Well, what that would mean is that if I have 3 losses in a row, what I'm going to do is I'm going to listen to the market. Okay, 3 losses in a row, that's quite a bit. I need to adjust my position size because this hasn't worked out for 3 times now. And so I'm going to cut that in half. And so now I'm only trading with 50 shares. Now, one of two things is going to happen. I'm either going to start gaining money again, or I'm going to continue losing. So if I lose 3 more times, then what I'm going to do is I'm going to cut my position size in half again. And now I'm only risking 25 shares on a trade. And my rule of thumb is that I'm going to keep lowering it as long as it's not working out until things start working out again, until my trading style, my edge, if you will, starts playing out again. And a rule of thumb for this for me is I am quick to scale up in size and I'm slow to scale down, which is why I say if it's three losses in a row, then I scale down further. But all I need is 1 win before I scale back up to the next level up to kind of test the waters to see, is the market getting hot again in my trading edge? And the reason this is important is because when the market changes its direction, it changes direction quickly. And you do not want to continue trading small size in a hot market, because then when the market turns on you again, you will start losing money. It's actually been shown that after large drawdowns in things like the S&P 500, the largest gains happen when the market shifts immediately. And what happens is a lot of people pull their money out, they sit and they wait for the market to pick up, and then they've missed the majority of the momentum and the majority of the move trying to time the market because they didn't get in soon enough. And I don't want to do that with my trading. So I'm quick to scale up. When the market's hot, when my edge is hot, I'm scaling up into full size as quick as possible. So let's say I'm down to like 25 shares. Now I get a win under my belt. Well, now I'm scaling up to 50. I get another win in my belt. I'm scaling up to 100. I have a couple losses. Okay, back down to 50. All right. I have another win, back up to 100. Couple more losses, back down to 50. Few more losses, back down to 25. Oh, I've got a win, back up to 50. I'm constantly adjusting my position size in response to what the market is trying to tell me. And that is a beautiful form of risk management. And if you actually trade that, you need to know that it will actually take you, I did the math on this, it will take you about An 8% loss, adjusting your stuff like that requires 10 to 12 losing trades in a row before you hit your 6 to 8% stop loss that I was talking about, which is why this is a very good way to manage your position sizing, because you get 10 or 12 losses in a row before you finally hit an 8% monthly stop loss on your account, before you hit a point of no return. But you can exponentially increase your gains by sizing up when your edge is playing out. And so you always want to be listening to the market and adjusting your position size based on that.